SoFi stock is currently trading below $15, but just a short while ago, it was around $18 before their earnings report was released. This raises the question, is SoFi a strong investment opportunity for long-term growth, particularly looking ahead to 2026 and beyond? Hello everyone, welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But before that, alert, this is not a financial advice video. Recently, several analysts have downgraded their outlook on SoFi, expressing concerns about the company's ability to meet its projected targets for both this year and the coming years. Some analysts have gone so far as to rate the stock as underperform, with one firm setting an almost dismissive price target of $7, despite initially estimating it at $8. Despite these negative ratings, SoFi has consistently exceeded earnings expectations over the past 4 quarters, maintaining a perfect record of surpassing forecasts. Looking ahead to 2025, expectations remain strong, with projections indicating at least 3 quarters of double-digit growth. The current forward price-to-earnings (PE) ratio sits at approximately 60.3, prompting discussions about whether the stock is attractively valued or overpriced. The company's CEO has confidently stated that 2024 was SoFi's best year yet, emphasizing strong business opportunities that could further enhance growth. Projections for the next quarter estimate revenue in the range of $725 to $745 million, which exceeds Wall Street's expectation of $688 million. However, earnings per share (EPS) came in at just 0.3, below the anticipated 0.5, contributing to an 11% decline in share value following the earnings report. After briefly reaching $16, the stock has since fallen below $15. For the full year of 2025, SoFi expects revenue between $3.2 billion and $3.275 billion, surpassing Wall Street's $3.02 billion projection. However, analysts remain disappointed with the EPS forecast, with SoFi estimating between 25 and 0.27, while Wall Street projected 28. This discrepancy in earnings expectations is a key reason the stock has struggled since its earnings release, declining from above $18 to its current levels. In Q4, SoFi exceeded revenue expectations, reporting $739 million compared to the expected $675 million. The company's financial services and technology platform now contribute a record 49% of total revenue, up from 40% in the same period last year. CEO Anthony Noto emphasized that 2024 was a transformative year during which the company diversified its business, reduced reliance on capital-intensive operations, and strengthened profitability to maintain a solid balance sheet. Looking ahead, SoFi plans to increase its investment rate in 2025, anticipating significant returns. Noto remains optimistic about the company's future, stating that the best is yet to come. However, the company's valuation is a key point of debate. Currently, SoFi trades at a forward valuation approximately 430% higher than the sector median. Although this premium reflects the company's impressive growth, investors must weigh whether the valuation is justified. From a growth perspective, SoFi has been performing well, with a year-over-year revenue increase of 28%. Projections for the next year suggest a 22% growth rate, significantly above the sector average of 6 to 7%. Historically, the company's revenue growth has been even stronger, and EBITDA growth stands at an impressive 41%, highlighting its outperformance compared to industry peers. Despite these strengths, SoFi still faces profitability challenges. While its gross margin is robust at 83%, higher than both the sector median, 59%, and its 5-year average, 78%, net income margin remains at 19%, slightly below the industry average of 22%. For years, SoFi struggled to achieve profitability, and while it has made progress, cash flow remains a concern, with cash from operations still in the negative. Nonetheless, investment analysts have mixed opinions on the stock. Seeking Alpha considers it a buy, while Wall Street has generally rated it as a hold. The company has received a D grade for valuation and profitability, though it boasts an A in growth potential. Compared to other major names in the consumer finance industry, SoFi has seen strong performance, with a 95% gain over the past 12 months, second best among its peers. However, Past performance does not guarantee future results, and whether SoFi can maintain its momentum remains a significant question. One of SoFi's most impressive metrics is its growing user base. Over the past few years, the company has seen a 53% increase in new members, surpassing the 10 million mark. Although growth is slowing compared to previous years, down from triple-digit increases in 2021, its compound annual growth rate, KGGR, still stands at an impressive 55%. Similarly, product growth remains strong at 32%, but the rapid expansion seen in earlier years is beginning to taper off. Revenue growth remains solid at 26%, but the pace of expansion is slowing. However, EBITDA margins are improving, which is a positive sign for long-term efficiency. Most notably, 2024 marked SoFi's first full year of profitability, with a net income margin of 9%, a significant turnaround from prior years when the company operated at a loss. When comparing actual performance to projections, SoFi has consistently exceeded expectations. Initially, the company forecasted 14 to 16% revenue growth for 2024, later revising it to 22 to 23%, and ultimately reporting even higher results. This trend suggests that future guidance for 2025 could also be revised upward, contrary to Wall Street's concerns. Current forecasts indicate 23 to 26% revenue growth and 9% net income margins, maintaining a strong trajectory. SoFi's Q1 projections are equally promising, with anticipated growth between 25 to 28% and an EPS of 3 cents, surpassing last year's 2 cents. While analysts remain skeptical, history suggests SoFi may outperform expectations again. A key factor impacting SoFi is the Federal Reserve's interest rate policy. Recently, the Fed held rates steady, which has direct implications for SoFi's business model. Since a significant portion of SoFi's revenue comes from lending, including personal loans, student loan refinancing, and mortgages, higher interest rates can make borrowing less attractive for consumers, potentially slowing growth. If rates remain elevated, SoFi's stock price may face continued pressure. However, if interest rates decline more than anticipated, SoFi could benefit significantly. Another major consideration is refinancing activity. When interest rates are high, fewer people refinance their loans, which affects one of SoFi's primary revenue streams. While this has not yet had a drastic impact, it remains a potential risk. Furthermore, growth-oriented companies like SoFi tend to be more sensitive to economic conditions. If borrowing costs remain high and economic uncertainty persists, investors may become more cautious, leading to additional stock price volatility. Conversely, if the economy strengthens and interest rates decrease, SoFi could experience accelerated growth. Finally, SoFi must manage its own borrowing costs. If the company relies on issuing bonds or taking on debt to finance its operations, high interest rates could increase costs and pressure profitability. If SoFi is unable to pass these costs on to consumers, its margins could shrink, negatively impacting its financial performance. Institutional investors currently hold around 38% of SoFi's shares, indicating strong interest from major financial players. However, continued market fluctuations and economic conditions will play a crucial role in shaping the company's future trajectory. Investors should weigh these factors carefully before making any decisions regarding SoFi stock. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.